Hello and welcome to the latest Insider interview. Our guest today is Helen Steers, manager of the Pantheon International Investment Trust. Helen, thanks very much for coming in.
It's a pleasure, Sam. Thank you for inviting me.
Interest rates have risen a lot over the past 3 years. So the Bank of England rate is now 5.25%. How does this affect the private equity industry?
Well, I think people get a little bit worried about rising interest rates because clearly when you're doing a buyout, you are using debt to help do that transaction. However, what I would say is we are invested mostly in small and mid-market buyouts, and they tend to use much less leverage, so much less gearing than the very big buyouts that you might read about in the newspaper. So on average, we use about 5.2 times earnings to debt, and on average our companies have a holding value of about 18.5 times earnings to enterprise value. So you can see there's a very large sort of equity cushion, as we call it. So with rising interest rates, it does add to the cost of doing the transactions, which means that the fund managers just have to work a lot harder to provide that growth and that sort of value add. Now again, the types of businesses that we're investing in are these high growth businesses, so they're growing earnings at an average of 19% per annum, and therefore most of the value add is actually through this operational value add rather than through financial engineering. So I think that's a really important point to make in our portfolio.
And these higher rates is one of the reasons that the discount has widened on the trust, but rates appear to be plateauing or potentially could fall towards the end of this year. Could that be, therefore, a tailwind for the shares?
I do think that this worry about interest rates has affected sentiment in private equity, and that probably is one of the reasons why the discounts have widened right across the sector. I think it's important, though, to stress that the private equity managers are still underwriting the deals to the same rates of return that they were before. So even though interest rates have gone up, they are looking for other sources of operational value add. And as we see these exits coming through from our portfolio, even now in more difficult times, at uplifts to the holding value, we can really see the proof of the pudding. So I think, yes, if we start to see interest rate cuts, that could affect the sentiment. But I also think as we keep on reporting these great exits, big uplifts and nice exit valuations, that will also help bolster confidence, I think, in the trust and in other private equity trusts.
We had you in the studio about 2 years ago. So what has changed in the portfolio since then?
So we've continued to lean more into direct investments. So the trust actually started out 36 years ago just investing in funds. And in fact, until 10 years ago, it was still just investing in funds. But now the weight of the portfolio has really shifted towards direct investments. So about 56% now of the portfolio is directly invested in companies, 46% into funds, and that direction of travel is ongoing. So we continue to do more direct investments, either through co-investments, going directly into the equity alongside our managers, or through these single asset secondaries where we're buying single assets from other private equity firms.
And why is that beneficial for shareholders?
I think it's beneficial because we're essentially using a kind of a double quality filter when we're going into these companies. So the first quality filter is only working with the very best private equity managers. And in private equity, there's a huge dispersion of performance between the best managers and the least good managers. And in fact, between the first quartile and the third quartile managers, it's about 2,000 basis points. So first of all, you need to work with the best managers. That's kind of essential. And then secondly, we get to choose the assets that we're investing in. So we've got the top quality filter with the manager, and then the second quality filter with the company. So we're able to really rifle shot the types of companies, the sectors, the geographies that we invest in. So I think that's a lot of value add for investors in the trust. And I think you can start to see that coming through with this higher NAV performance. You know, I mentioned it's close to 14% over the last 10 years versus 12% over the long term, net of all fees.
And in terms of the sectors and types of companies you own, we've seen a lot of change over the past 2 years in the economy. Has that affected what you like to own, or are you still sticking to your long-established process?
Well, I think we continue to lean into what we see as the most resilient, robust areas of the economy. So that really started probably more than 5 years ago. But I think we're now able to be even more selective about the micro sectors that we invest in. So around 53% of the trust is invested in information technology, but what I would call kind of boring information technology. It's these software packages I spoke about earlier, and healthcare. So those resilient areas of the economy continue to be what we like to see. In terms of consumer, we do very little consumer, and I think over the last 2 or 3 years that we've shown that's actually been quite a good decision. So consumer staples, consumer services, but not consumer discretionary.
And lots of inflation recently, perhaps some cost cutting from companies to try and manage that. Have your portfolio companies weathered this economic storm well?
They've actually weathered it very well, and I think that's a testament to the real sort of hands-on active management that you get in private equity. So the private equity managers control their businesses. They have majority control, and that means that they can change management, they can direct the companies in different places, they can make acquisitions. So they're really able to control those businesses. And over the last 2 years, with higher inflation, we have seen both cost cutting, which they're able to do, and that line of command is very, very short. But also interestingly, we've seen the managers sort of lean into some of the areas where actually you can pass on price increases. So almost, because of inflation, you're able to increase prices and pass those prices on to the end consumer. And if you're investing in things like accounting software, those prices are actually quite easy to implement. You just pay a higher subscription, at the end of the day.
And fees is an area that private equity is often associated with high fees. But how expensive is the trust, and is there a performance fee on it as well?
Yeah, so private equity is a very sort of hands-on active style of management, and the types of managers that we work with not only have the investment professionals, but they also have operating partners, they have people that actually go into the portfolio companies to really help do that sort of value add. So it is very hands-on, and it does take expensive people to do that. It does tend to be more expensive, but then what you get at the end of the day, and why investors should consider it, is that you are getting this sort of increased performance over the long term. So you should be getting 2 or 3% net over public markets over the long term. So on a net basis, you should be much further ahead. So there is a performance fee on the trust, but it only kicks in after the NAV per share reaches a certain value, and that high watermark is £5.61. So we're actually out of the money at the moment, and there's actually considerable headroom there. So there is no performance fee being paid at the moment at all. The ongoing charge for the trust, the AIC ongoing charge, is 1.31%. If you go onto the fact sheet and you click on the term sheet and the KID costs, you'll see a higher number there. I think it's around 3.6%. Now that's on the look-through basis. So what happens is when we make an investment in a fund, and 46% of the portfolio is in funds, we have to pay both a fee, a management fee to the manager, but also a carried interest or a performance fee. And rather ironically, the better the manager does, the higher the performance fee. So in some senses, it's a little bit strange, because the higher the performance fee, it means the higher the performance you're getting, and therefore the higher the look-through cost. But what I should explain is that the 12% net since inception and the 13.8% net over the last 10 years is net not only of our fees, but all of the sort of the look-through fees that you'll see in that KID.
And finally, the question we ask all of our guests: do you personally invest in your trust?
Yes, I do, and I've been investing in the trust for the last 20 years, actually. So it's gone into my ISA, it's gone into my pension plan as well. And what I tend to do is that I invest regularly every month. So I use sort of pound cost averaging. It's probably worth saying here that right across Pantheon, the trust is very widely held. So a lot of people at Pantheon hold shares in the trust. We can't report on all of the holdings for compliance reasons, but I can say that 18 partners at Pantheon hold around 1.6 million shares in the trust. And then I should also mention that our board, which is a very high-powered board, completely independent of Pantheon, there's nobody from Pantheon that sits on the board, holds 3.8 million shares in the trust. So they've also got a lot of skin in the game, which is nice to see.
Yeah, good to see that there's lots of alignment between the shareholders and the management team.
Absolutely.
Helen, that's been very interesting. Thank you very much for coming in.
Sam, thank you very much. Pleasure to be here.
And that's all we've got time for. You can check out more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.